I'm going to go through the Data-Driven Advisor main presentation. We're going to start with what is diversification. Here we see a risk and return chart with average annual return going up and down and risk going across horizontally. Now I'm showing 7 different asset classes broadly covering the entire world, from US stocks and bonds to international stocks and bonds, real estate, gold, and commodities. And we're showing data from 1970 to 2017. There's nothing magical about starting in 1970, merely gives us a long enough time frame where we've seen just about everything. We've seen stocks rise and fall, interest rates rise and fall, etc. When looking at this chart, what stands out to me is this blank space in the top left. This is the low risk, high return space, and for some reason the world doesn't want to give away low risk, high return options. When I point that out to people, they often instinctively go to the opposite end of the spectrum. They go to the low return, high risk space where they see gold and commodities. And most people don't own a lot of gold and commodities, and this chart tells us why. Next, people often go to international stocks and real estate. While those might be interesting, over time US stocks have had less risk and higher return. So most people don't own a lot in international stocks and real estate. Then they can look at international bonds, and while that button might seem interesting, it seems really close to US bonds, and most people think international bonds are weird, so most people don't own a lot of international bonds. What many people are doing is trying to determine, do they want more in low risk, low return US bonds or more in high risk, high return US stocks. But let's step back for a minute and just look at US stocks and gold over this time period. Now, if we went into a time machine and went back to 1970, now with this chart, we would know the future. And the question is, which of these two assets would you want to put your money in, US stocks or gold? Well, knowing what we know, people would choose US stocks that had lower risk and higher return over this time period. But my question would be, what if, starting in 1970, we put half your money in US stocks and half your money in gold, knowing that gold was going to have lower returns and higher risk? Well, most people think if you put half my money over here and half my money over here, I'd be right in the middle. But what actually happened over this time period is US stocks and gold had low to negative correlation. When one was going up, the other was often going down, or vice versa. So if we put half your money here and half your money here, we actually would have wound up over here. We would have drastically cut risk without harming expected return very much. So, going back to this chart, we can see it's really striking when we look at it visually. The red line is US stocks, and we can see it was a wild ride. The yellow line was gold, which drastically underperformed, but that combined portfolio was much smoother and was very similar in the end to US stocks. Going back to this page, the question is, how can you get towards the top left? It starts by not crossing out everything and embracing global diversification. In 1959, a guy by the name of Harry Markowitz looked at all this data and realized if he combined these assets reasonably, he can get towards the top left. He won a Nobel Prize, and this is called the tangency portfolio. And that is what we're trying to do with our portfolio. These are just the numbers behind the graphs we just saw. Average annual return for those 7 asset classes and then that diversified portfolio. What's interesting is that if you take out your calculator and you calculate the average return of these 7 assets, you'll come up with 8.5%. Yet I'm telling you that you actually would have earned 9.8%. How does that happen? Well, David Booth, his name is on the Chicago Business School, and Eugene Fama, he's won a Nobel Prize. They looked at this and they coined this phenomena, diversification return. It's the extra return you get merely by owning assets which act differently and by rebalancing. This is a nice segue between 2 different parts of the presentation, and this tells a really neat story This is the 6 worst calendar years from 1970 to 2017 for each of these asset classes. And let me run you through this really quickly. U.S. stocks, a perfectly fine asset. What was the worst calendar year? Well, it was 2008 when the market was down 37%. Note that this is a calendar year. Top to bottom from this market cycle, it was down 50%, but just calendar year was down 37%. And as you can see, U.S. stocks have had many down years, so many we can't even fit them on this page. U.S. bonds, that's the 10-year U.S. government bond, perfectly fine asset class, but many down years. International stocks and bonds, of course, many down years. Real estate, gold, and commodities, same story, many down years. That diversified portfolio would have only had 5 losing calendar years since 1970, only 1 calendar year losing more than 8%. Diversification is very robust. Now, what we looked at earlier was a backward-looking chart from 1970 to 2017. Now, I will be the first to admit, I don't think the next 48 years looks like the last 48 years. So the question is, what can we gather from the past to give us a guide to what the future looks like? So here is that 48-year average for the U.S. stocks, average return and risk. But what's interesting is we can cut this period up into 10-year periods, and we can look at every single 10-year period. We're not talking about decades like the 70s, 80s, 90s, and 2000s. We're talking about 10-year periods such as 1975 to 1984 and 1997 to 2006. So let's look at those 10-year periods, and here's what they are. What we can see is that an investor believes they're going to get that long-term average, but even when holding that investment for a decade, it's very, very hard to get that long-term average. They can get a decade where they get very lucky, averaging almost 20% per year, or a decade where they're unlucky, averaging about 0 per year. But now most people are not just in the S&P 500 or U.S. stocks. Most people have this hybrid portfolio, 70% U.S. stocks, 30% U.S. bonds, or thereabout. And we can look at that portfolio. What's interesting is you take 100% U.S. stocks, add 30% U.S. bonds to it, and you hardly affect your expected return. What you do is you get a smaller range of outcomes. But even with that portfolio, we still don't know if we're going to get a lucky decade or an unlucky decade. It's hard to get that long-term return. Now we can look at that globally diversified portfolio. What's interesting is that the long-term returns are very similar. The range of outcomes is much smaller. In fact, there were a few decades where if you got unlucky, you would average 3 or 4% per year for a decade. The rest of the decades were similar to what a long-term investor would have expected. Similar long-term returns, but very different range of outcomes. And this is my favorite chart. I believe we can use this chart today to determine what's going to happen going forward. And the question is, do we want to embrace U.S. stocks going forward and go for one of these red dots? Do we want to embrace the standard 70-30 portfolio and go for one of the yellow dots? Or do we want to embrace global diversification and go for one of the green dots? Let's talk a little bit about the process. Everything is data-driven using facts at hand. One of the facts we use are size when we're thinking about portfolio positioning. What's interesting is whether we're looking at world GDP, the size of the world stock markets, the size of the world currencies, or global debt outstanding, while the U.S. market is often the largest market, it's often a minority of the global economic pie. Going from size, we then factor in valuation. We use both Shiller PE, Robert Shiller won a Nobel Prize, and market cap to GDP, Warren Buffett likes that metric. Now, we don't use these because Robert Shiller won a Nobel Prize or because of Warren Buffett. We use these because they work well. Here's the chart for the U.S. Shiller PE over time, and what we can see is at low valuations, we get high returns going forward. And at high valuations, we tend to get lower returns going forward. Same story holds for market cap to GDP. We run this data on the top 20 or so countries in the world, and most of them have correlations of 80 or 90 plus percentage. It's not a crystal ball, but it does give an indication of the odds. As we can see here, in February of 2018, the Shiller PE for the US stock market suggested 3% average annual returns going forward, with 96% correlation historically. Market cap to GDP suggests 2% average annual returns going forward. This data has had 94% correlation historically. Both metrics are over one standard deviation away from median valuation. We factor this in, and currently we're using it to lower our exposure to US stock market based on valuation. Visually, here's the Shiller PE for the US stock market. We can see that it is extraordinarily high right now. The levels right now have only been breached during the top of the internet bubble. This does not mean that a crash is imminent, but it does mean that our odds of high returns going forward are low from here. Here's another chart showing Brazil. And what I like to say is that if you believe an asset class will behave different from the rest of your portfolio, the question is not should I own it, the question of it is how much should I own. If you go back to the S&P 500 and gold example, gold was valuable not because it outperformed, in fact it underperformed. It was valuable because it behaved differently. What's interesting is that I received a call in January of 2016 from a client who had just been to Brazil. And he said that he sat down with the CEO of Petrobras, the largest oil company in Brazil. What he said was that the CFO said Brazil was in very poor shape and was not going to get better. Now, what's interesting, in January of 2016, we all knew Brazil was not only in political turmoil, but also was suffering a severe economic crisis. The stock market was already down 42%. But also, in January of 2016, the Brazilian stock market was at the lowest valuation it had ever been at. We are in the business of buying things when they are cheaper than they've ever been. Brazilian stock market, despite their massive recession, was up 69% in 2016. Let's take a look at the portfolio. Visually, we can look at the Wall Street portfolio, and we can compare that to our typical portfolio just to compare the asset class weightings and diversification. We can also dive into each section of our portfolio. When we're looking at the equity side, what's interesting is to know that not only can we tell you exactly how much we have in every single country, but we can tell you exactly why that is. It's all through a data-driven process. And we can do the same thing on the debt side. That concludes the main presentation. I'll run you through a couple of quick addendums really quickly. Addendum number 1, primer on risk. We've all been told that there's a correlation between risk and return. The more risk you take, the more return you should get. Now, when we look at the lower end of the risk spectrum, stopping risk at 9%, we can see that over time this has been true. The more risk you've taken, the more return you've received. But when we expand risk to show the whole chart, we expand the data to include 55 different assets, including German stocks, Japanese bonds, real estate, oil, etc. We can see that that upward sloping line disintegrates, and there doesn't seem to be a pattern between risk and return. Moreover, when we look at the data set above 10% risk, we can see the average annual return for all of these assets is 8.6%. At somewhere around 10% risk, increased risk did not increase expected returns. But what did it increase? Risk is all about range of outcomes. The more risk you take, you're not expecting higher returns, but what you do is you get higher range of outcomes, higher good periods and lower bad periods. So what this chart shows is for every single dot on this chart, we can take that dot and we could go down here and we can see the best 2-year period and the worst 2-year period for each investment. and that globally diversified portfolio is highlighted in green, the best 2-year period and the worst 2-year period. So you'll note that this chart tells a different story. As you increase risk, you increase your upside periods and you increase your downside periods. Armed with the knowledge that after 10% risk, you are not increasing expected return, you are merely increasing range of outcomes. We are encouraged to lower risk and target a portfolio with risk somewhere around 10%. Addendum number 2, this is the risk and return chart since 2000. A lot of people get hung up on that one chart, 1970 to 2017, and I like to show people that the numbers change based on when you start the data. What is usually consistent is that diversified portfolio tends to be towards the top left, while all the other dots tend to move around. Addendum number 3, can lower risk increase returns? The question is, if 2 investors start with the same amount of money and they both average the same returns, can one make more money than the other? In this example, if investor A is up 4% one year, 6% the next, and they repeat that over time, averaging 5%, or investor B can be down 10% one year, up 20% the next, they'll repeat that cycle, averaging 5%. Over time, the lower risk investor wins out. And this is because of the tyranny of going down. If you are down 10%, you need to be up 11.1% to get back even. If you are down 25%, you need to be up 33% to get back even. If you are down 33%, you need to be up 50% to get back even. When you go down, it is harder for your portfolio to get back up. That is why lower risk wins out over time. Here are our disclaimers. Feel free to reach out for more discussion.